I hope by now your survey would have been complete and you would have analyzed the taste and preferences, the pricing, branding, health benefits, choices, etc. that your customers want from your product or service. And I hope this survey would have more than 100 customers as of now. So here, taking you forward with the CFO course, we have the following videos. The first thing that we need to look upon is how should a business ideally get started with loan. A loan is actually a borrowing, a liability on the business. Why is it that the business would need loans? Absolutely. When the business is short of funds, that is where the business needs loans. These loans can be for procurement of new raw material, new resources, hiring of new people, etc. There is a big deal when it comes to getting a loan for beginners. You must have read about it and you must be aware about this fact that there needs to be a mortgage when it comes to loan. So when we are talking about the loan procedure, the banks take in some kind of mortgage and give you a loan only after that. The mortgage should be of a higher value than the value of the loan that you are taking. The loan repayment has to be done in easy installments monthly that has been decided mutually between the lending authority and the business owner. But it's not that easy that it sounds, because usually businesses do not have any kind of mortgage to be put up in place of loan. There are other steps as well that have to be considered while taking a loan. The business module, the business planning, etc. Last year's balance sheets have to be shared by the business owner with the bank or the lending agency. If you go for a private lending agency, that is where your interest rates go all the more higher. When we're talking about all these tools, loan is one where we are talking about a biggest change occurring in any organization, because this loan has to be repaid back by the organization within the tenure that is decided between the lender and the borrower. Any idea what happens if the borrower is not able to repay the loan? Yes, the mortgage becomes the property of the lender. Here, the lender has 100% rights over that property. Watch this quick video and get started with the startup loans for beginners. What are the properties? What are the documents? What are the mortgages? And where all can you apply for loan? Watch it. Come back bubbling with curiosity. While we're talking about all the documentations, you're aware that we need a lot many documents when it comes to applying for loan. Any idea that what are these documents? No? Okay. When we are applying for a loan, let's get started. First comes out to be your identity proofs. These identity proofs make you a citizen of India, and these identity proofs mark you as a person who is a legal citizen of the country. The loan application procedure is complete only when these document verifications are successful. So whether it be any kind of loan, this applicant has to provide all the necessary required documents. And the importance of the documents is different depending on the kind of loan you're taking. Whether you're taking a personal loan, whether you're taking an unsecured loan, your income proof, your salary slip, and etc. are the highest priority. When we're talking about the secured loans, wherein your home loan comes into picture, your loan against property comes into picture. So utmost important documents here are forgotten because you have a mortgage here. So when we're talking about all these documents, let's talk about them in detail here. This video is going to tell you the proof of residence, they're going to talk about proof of identity, they're going to talk about list of bank statements, passbooks, Aadhaar card, telephone bills, last 6 months salary slips, and copy of all the properties that this person holds and their relevance. So here, when we are talking about all these documents, let's see what their requirements are when it comes to loan taking. Watch the video and understand. Here, we're going to talk about all the financial analysis. Any idea what is financial analysis? No? Okay, let me get you through this. So when we are talking about financial analysis is actually the analysis or the assessment of the visibility, stability, and profitability of the overall business, sub-businesses, or a single project as well. It is performed by professionals who prepare reports using the ratios and other techniques that make use of information which is taken from the financial reports or the financial statements of the company. You must have heard a lot many times the ratio analysis, cash flow analysis, trend analysis, common size statements, comparative statements, etc. All these financial documents are of utmost importance when it comes to financial analysis. It is conducted internally, that means within the organization, and financial analysis can help managers make future business decisions, or they can even review what historical trends or the past success rates are. It is conducted, if it's conducted externally, means some external organization or authority is coming and conducting it. This financial analysis can help investors choose the best possible investment opportunity into a business. There are two basic types of financial analysis. The first one is the fundamental analysis, and the second one is a technical analysis. When we're talking about the fundamental analysis, they use the ratios and financial statement data to determine the intrinsic value of a security. Whereas when I'm talking about the technical analysis, they are talking about assuming a secure value, which is already determined by the pricing of my share. And the focus is mainly on the trends and the value over time. So when we're trying to understand, the entire economic trends, the financial trends, and the long-term plans for a business activity, we need to identify what are the projects that the company is going to invest into. And how is this analysis done? It is basically the synthesis of the financial numbers and data. A financial analyst will go thoroughly and examine the company's financial statements, which include the income statement, the balance sheet, the cash flow statement, etc. These are the important documents for any company. The financial analysis can be conducted in both corporate finance as well as investment finance settings. And one of the most common ways to analyze the financial data is to calculate the ratios. When we are talking about the ratios, we are talking about the ratios from where we determine the data in the financial statements to compare it against those of the other companies and compare it against our company's data as well. The ratios that were calculated last year versus the ratio that is calculated this year. That is comparing through our own historical performance. Let's take an example here to understand this better. When we're talking about the return on assets, this is a common ratio that we usually use to determine how efficient a company is at using its asset as a measure of profitability. So while we're talking about all these things, this ratio could be used to calculate several other things that measure the profitability of a business. So watch the given video carefully and come back bubbling with curiosity. Now, when we're talking about financial analysis, this is a very important tool. Why? Because when we're talking about the analysis, this analysis is not just conducted within the organization, but is also conducted outside the organization. And it's an important area of analysis which actually employs the company's performance. How the company is performing intrinsically, means inside, within the organization, versus how it's performing in comparison to its competitors. How people are going to invest, this is what is going to be analyzed through this. And there are multiple types of financial analysis, as I've explained to you. So here is a small video which relates to the trends, current trends, and types of financial analysis. I had explained broadly that there are two types of financial analysis, the fundamental as well as the technical analysis. So here we are talking about other detailings around these analyses. Like in the fundamental analysis, we use ratios gathered from data which are within the financial statements, such as the company's earnings per share, EPS, which we call. And in order to determine the business's value using the ratio analysis, in addition to go through a review of the economic analysis. So all these analyses are giving me the intrinsic value of the security. Whereas when I'm talking about the technical analysis, these are the statistical trends which I've gathered from the trading activity, such as the MAs, which are the moving averages, or I'm talking about the statistical analysis of price movements, the price drop or the price rise in the shares. Watch the video carefully and come back if you have any doubts here. The most important part of becoming a CFO is evaluating the balance sheet. When we are talking about evaluating the balance sheet, it seems to be quite easy, right? But it's not, because the balance sheet is a major portion of any company. It determines the strengths of the company as well as its weaknesses. How do we go about the balance sheet analysis is very important when it comes to the CFO's role. For investors, the balance sheet is an important financial statement that is usually interpreted when we are considering an investment in the company. When I, as an investor, wish to invest X amount into the company, I wish to analyze its financial statements, amongst which the balance sheet comes my top priority. The strengths of the company's balance sheet can be evaluated by three investment quality measures: their cash flows, their fixed assets, and the return on asset ratio. How many assets is that the company is holding? How many liabilities is it that the company has? And how many fixed assets are there with the company? What is the cash ratio? That means that we are talking about how much cash inflow versus outflow is there with the company. The cash conversion cycle, how fast is it? How slow is it? What is the difference when it comes between a company's current assets, such as the cash, and the current liabilities, such as the payables which are owed to the suppliers for raw materials? The current assets and liabilities are short-term in nature. They usually get sorted in quite some easy time, which means that they're usually on the books for less than 1 year. The cash conversion cycle is actually an indicator of the company's ability to effectively manage two of its most important assets, that is, the accounts receivable as well as the inventory. When we are talking about all these things, there are other things as well which we need to look into when it comes to the balance sheet, and that is the various ratios, like the fixed asset turnover ratio. When I'm talking about the fixed asset ratio, it measures how much revenue is generated from the use of a company's total assets. Since the assets can cost a significant amount of money, the investors would want to know how much revenue is being earned through those assets. And it's really important for them to analyze the same, whether they're being used effectively or not. So when we are talking about all these things, there are multiple other ratios and formulas that we have to use. You must have heard about something called as tangible as well as intangible assets. When we are talking about these two things, they are of utmost importance to any company. When we are talking about the intangible assets, we're talking about those assets which ideally cannot be seen, but their presence can be felt through the way the company works. Like in marketing, if you remember, we learned about brand value or branding. Similarly, we have intellectual properties such as patents, copyrights, trademarks, brand names, etc. We also have deferred charges like the capitalized expenses, the goodwill, which is the cost of an investment in excess of a book value. So here, when we are talking about all these things, it becomes really important to evaluate them. And that is where my balance sheet comes into picture. Watch the video carefully, analyze its nuances, and come back bubbling with curiosity. Now comes the most important part of the CFO's role, which is talking about the tools and strategies for decision making. When we're talking about the tools and strategies, we have to make sure that all these decision making process revolves around the problem that we have identified. What amount of information do we have related to the problem? And we need to identify the alternatives as well. When we are choosing amongst the alternatives, we need to evaluate each alternative carefully. We need to understand that each alternative holds a high value. And we need to understand and determine that alternative that's going to give us maximum return. But this doesn't solve the problem here. The CFO further has to review and monitor the results till the final go. He cannot simply say that I've decided now, this is what I've chosen, and here I give up. No, till the time the project is complete and complete to a stage wherein it's said that now it's come to a closure, the CFO cannot give up. Let's understand and check out a few of these strategies. First comes my marginal analysis. My marginal analysis talks about my benefit is to my cost. What is the cost that I am investing into a project versus what is the benefit that I'm going to reap out of that? When I'm talking about the cost is to the benefit, it is talking about the return on my investment. What is the amount of input that I am giving into a project versus what is the kind of output that I'm going to receive? It's a very effective tool made for decision making because it takes preferences, resources, and information constraints into account. So managers here ideally make more optional and more optimal decisions related to the information that is provided to them. Here, to conduct a marginal analysis, you need a variable such as the quantity of an input that you use or the volume of the inputs that you produce. So once you've identified what kind of a variable you're determining, that is where the increase in total benefit, what is going to be, and what is going to be the unit of control variable that you're going to add, that needs to be identified. While we're considering all of this, you must have guessed by now that we also need to add goods that would be calculated here, which involve marginal cost. So here, the increase in the total cost is one of the variables that we are adding here, and we are making the marginal cost outweigh the marginal benefits. So here, evaluation of the marginal cost is utmost important. Next comes out to be my decision matrix, wherein I'm evaluating both the pros and cons. Before making an investment, it's ideal for a CFO to see and check what are both the pros and cons. Weighing both the pros and cons would help this person evaluate whether to go for this particular project or not. So when I'm talking about all of these things, here, I'm dealing with multiple choices and variables. So a decision matrix can bring clarity to this discrepancy that's there in my mind, whether I should do it or I should not do it. Now the question comes up, how to go about it. We have to list our decisions and the alternatives that we have. Next, we need to find the relevant columns of pros and cons, and we need to determine all the pros and cons of these alternatives that are there in front of us. We need to assign weights in accordance to the pros and cons that we have identified. Weighing and measuring here would help us analyze the sheet better. Why? Because it'll add up all the factors of my decision making, and it'll give me the highest point value wherein I can simply go and invest. Here is a small decision matrix as an example if you see. So I have 3 vendors, vendor 1, 2, and 3. I am judging them on the basis of their capabilities, reputation, reliability, as well as the pricing that they are offering. So now the importance I have given to each one of them is 2, 1, 1, and 2. That means 2 pointers for capabilities, 1 for reputation, 1 for reliability, and 2 for pricing. Now, if I evaluate this complete table, do you see vendor 1 receives 8 pointer in capabilities? Which out of the 3, vendor 1, 2, and 3 receives the highest? Yes, it's vendor number 2 who receives a 9 pointer. Under reputation, we have the values 3, 7, and 6. Definitely, it's again vendor number 2 who's received the highest point value, that is 7. Reliability, we have 3, 7, and 9. Now here, vendor 3 comes out to be more powerful and reliable. Talking about pricing, we have 7, 3, and 8. So here again, vendor 3 comes out to be more in terms of price. That means he's offering us the least price possible. If we total from left to right, the total for vendor 2 comes out to be 38, which is my total points here are the highest for vendor 2. That is where I am going to select vendor number 2 here. I hope you've understood the decision matrix. Please come back in case you're finding any issues here. Next comes out to be my Pareto analysis. In Pareto analysis, it is known as the 80-20 analysis. Here, it helps in identifying the changes that will be there as the most effective ones in your business. So here, when we are changing the 80:20 ratio, we have 20% of the factors which contribute to 80% of the organization's growth. Means that they are the least factors which contribute the maximum share of growth in an organization. Let's understand this through an example. Here, the principle applying to business management would be 80% of the sales that are coming from 20% of my customers. Here, we're talking about those customers who are loyal to the business. And we're talking about those customers who would bring me maximum revenue and generate maximum profits for my company. So when we are identifying those small changes that lead to large impact, we need to prioritize as to what decisions we are making, and they shouldn't be affecting their choices. So these 20% population would be influencing my decision making the most. So this Pareto analysis ideally allows my managers to dedicate their energy as well as their resources towards this small segment of people so that they are happy and satisfied, and ultimately we are leading to better businesses. Here, let's recap the entire session and let's see how the various financial models as well as the startups begin. Let's talk about strategy now. What do you understand by the term strategy? You must have heard this term a lot many times by now. Yes, a strategy, when we are talking about, is the ideal approach that we are using for a business. So here, when we are talking about strategy, we are talking about a plan of action that is designed to achieve long-term as well as overall growth of the organization. Why is it important and how is it beneficial for a business? That is what we're going to look at. So when we are talking about the strategy, the managers and my C-suite people come into picture. So here, strategy, we are talking about the action that the managers take to attain one or more of the organization's goals. And strategy can also be defined as a general set of rules that the company and its components have to follow. There are multiple features that come and fall under strategy, and here we're talking about the significant one. Through strategizing, you can look at the future and you can predict and foresight what's going to come next. There are going to be multiple uncertain events that constitute to the business environment. We cannot point out all of these in advance, but we can definitely talk about them. Next one, we're talking about the long-term strategy, something that is developed for the long term. That is, it deals with the possibility of innovation or new products or production or moving into a new market. That's going to happen in the future. It is taken to create, it's actually created, and it takes into account the probable behavior of the customers, the competitors, how they're going to deal with the given situation, etc. So when we're talking about all these things, our vision and mission statement of the organization comes into main account. Here, I give you the first task for the day, which is creation of your vision and mission statement relating to your organization. So, plan, be decisive, view the competitors, and decide your vision and mission statement. With this, we'd like to put an end to this module. Thank you so much. Stay tuned.